For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future.
Well, yes, it is. Sure is. Welcome back. It is the podcast you should be listening to. Well, you are listening to right now. So am I, Johnny Dean, your podcast host here, longtime podcast host, and my longtime co-host and guest or whatever, Rick the Professor Plum, certified financial planner professional and accredited wealth management advisor. Rick, you've heard the word truth bounced around. I mean, does anybody know what real truth is anymore?
Well, you just watch the news. You get nothing but the truth from the politicians out there.
Well, I mean, I see
facetious.
I see one say, well, here's the truth. And you go and somebody says the complete opposite. Well, this is the truth. So it's the word truth gets bounced around a lot, but I think we can use it in today's episode. Now, what I found I originally found 4 financial truths that I think most people don't know, and then I found a 5th. So I'm going to make this 5 financial truths. I know last week we did 5 things you didn't know about estate planning, but this week 5 financial truths that most people don't know. And I think you might agree with these as being truths. I don't know how you can really refute them necessarily. I'll tell you what, Rick, longtime listeners to this show, they know we love to talk about strategies, what to do with your money.
Well, that's the only way you can do things because the future is somewhat unknown, I have to say.
I would say it's almost certainly.
You need a strategy to not only try to navigate the financial markets, but you need a strategy to control your emotional reactions to those things.
Yeah, and in fact, that's going to play a role in some of the things we talk about today. But we've talked about asset allocation, asset location, how to take income, cash flow. But I was thinking about this, before you even get to the strategies, there are just some core truths about money and investing that if you don't understand them, you're probably going to run into trouble at some point. And by the way, I don't mean rules of thumb. Okay. This is different from that. You know how we feel about rules of thumb that can be broken, and they usually are. But these particular things we're going to talk about are just things that tend to show up over and over again, regardless of market conditions, I think, or where someone is in life. Now, Rick, I know you've met with a lot of people over the years. You've talked to clients and others. How often would you say that people come in and ask you about, say, I don't know, picking the best performing investment? Is that something you hear very often?
I wouldn't say it's very often, but we do get people saying, A, is now a good time to invest? And B, this is much rare. What's the investment for the best investment for the next 6 months? I was like, well, define best. The highest returning? The lowest loser? What are we trying to accomplish here?
Yeah. So you and I were talking before we got on the air here. We won't mention it, but there was a particular stock that you were looking at.
That I should have bought a year ago?
Yeah. It went up 2,000 something percent. I mean, I don't know. It's trying to find a single fish in an ocean of fish. It's just not something that you should be doing this. So, it's not usually about the investment itself. I would say we're talking more about how people think about money, how they react to it, and the assumptions that they bring in. So today I'm going to go through these 5 financial truths that most people don't know, or maybe they've heard of them, but they haven't really internalized them. And once you understand these, I think everything else we talk about during the other episodes, buckets, income planning, managing risk, all this starts to make a lot more sense. So, Rick, let's just jump into these one at a time. I haven't given you any of these, so I'm springing these on you, but these should be no-brainers for you. The first financial truth is that you need to save money.
Well, kind of, yeah. I talk about this all the time. The hardest part about investing is not picking a good, you don't worry about picking the best. Pick an appropriate investment for what you're doing. The hardest part is not finding that appropriate investment. It's prying the wallet out of your pocket.
Yeah.
It's getting the money and to actually invest. You could be the best stock picker in the world, and if you don't have any money to put into the investment, you ain't making nothing. You got nothing going for you.
You're
because
right.
you have to find a way to set money aside for the future to
Yeah,
be,
you're
if
saying
you want to
building
be
wealth-
an investor.
You're saying building wealth has less to do with finding the perfect investment than it does with consistently setting aside money early and often,
Oh, yeah.
so it has time to work for you. Now, why is it that people tend to look at saving money as almost like, well, this is money that I can't spend? I mean, I kind of like it available.
Yeah, I mean, it's a matter of budget. It's a matter of perception. It's a matter of how we feel about, I just can't afford. And I remember I was there. Hey,
me too.
I just couldn't afford it until I realized I couldn't afford not to. Now, I didn't start with, $15,000 a month being invested. I started with $50 a month being saved, just taken away from me. I had no idea what part of my budget that was going to come out of. This is 30, 40 years ago. I just decided that $50 a month had to come out of my checking account or whatever the number was. And it's amazing though. At the end of the month, I had about the same amount of dollars in my checking account when I did that, even compared to when I did before. I still had the same $2 left in my checking account at the end of the month. I didn't have any money left, but I don't know what part of the budget it came out of. I don't remember cutting back on anything, but obviously I did somewhere. But I found that once I started that systematic ongoing savings, I didn't notice it. And then I was able to then increase it periodically to where it started to matter and actually had some money saved up. I actually got an emergency fund. I was able to pay, non-monthly bills like car insurance and other things that came around, big bills. Like, oh my gosh, where am I going to get the money to pay for that? I could pay them. It was like without scrambling, and it created actually some comfort in doing so. But it took me a long time to be able to set that up, to pry the money out of my pocket.
Yeah, it happens. And it was the same thing with me with a 401k. It took me 6-7 years, I think, in my 20s before I finally realized it was a good idea. But obviously, this is something you got to do. You got to save money. If you don't save money, you're not going to have any to invest, and you're not going to be able to use it. So that's the first.
It's on you, though. Not you, John Dean, but you, the individual. Years ago, I was talking with a friend of mine who's smart. And she was saying, the government doesn't allow me to save. This is back when the 401k limits were a lot lower. The government doesn't allow me to save very much. I was like, well, what's the government got to do with anything? Well, they put limits on how much I can save in my 401k. It was less than 10 grand back at this time. And I go, so? Well, they only let me save 10 grand. And I go, no, they let you save 10 grand on a tax deferred basis, but that doesn't mean you can't save in other ways, and probably should, because having different types of accounts when you get out to retirement and through the years is, nice to have. But she was equating what the government allowed us as a tax deduction. She was saying it was the government's fault that they weren't allowing us to save more. No, it's just not getting a tax deduction. But there's easy ways to blame somebody else for you not saving.
Yeah, people like to blame the government for all kinds of ills, but that's
up to you. It's up to you to do the saving.
That's why we said that. So that is a truth. You need to save money. Now let's go to the second one here. We don't have to spend a lot of time on this one because I think this is kind of obvious. But the second truth, financial truth, is that money doesn't buy happiness, but it buys two things that are very important: freedom and options. Now, I don't know anybody who says, I just bought, 5 years worth of happiness. It doesn't happen. But what does give you happiness is stress reduction and the ability to choose how you live and work. And I think that's what people want. They want options,
It doesn't buy happiness, but it can buy a certain level of stability. It can buy a certain level of, I'm trying to find the word. It doesn't buy happiness, but it can buy a lot of distractions from other things, and it does let you not worry as much. It's a reduction in anxiety.
Well, and I think the reason it is because it gives you. I go back to the word options. It gives you options. If something happens where I lose a job or something, then at least I have maybe a couple of months of rent or mortgage payments or whatever. It buys you just a little bit of wiggle room there. And as I said, I know this seems obvious, and it probably is, but there are people who start making a lot more money, and then they kind of raise their lifestyle to the point where they spend all their options away. And
if money bought happiness, every lottery winner out there would be ecstatic. And the reality is, the majority of them are broke. And their lives have gotten screwed up.
Oh man!
I mean, the stories and the statistics and of the people that it's not just that they lost money, but they're miserable. And even when they had the money, they're miserable because they've got everybody and their brother clamoring to get it from them.
My best friend, you're my best friend.
Who are you?
Don't know your name. I remember this just very quick. My college roommate, I remember this, went from making $8,000 a year as a graduate student to making, I think it was like 70 or 75,000 with his new job. All right. Yeah, I mean, that's a lot of money. So what does he do? He moved out of our crappy rent controlled Santa Monica apartment at like $190 a month into this luxury condo off of Bundy that he was renting in West LA. And I ran into him a year or so later and I said, how's it going? He said, oh man, I can't pay my bills. I said, weren't you that way, in our little crappy apartment? Well, yeah, but I've got a nice place now, but I can't save it. And I was like, oh man. So it didn't buy happiness, and as I said, my roommate spent away his options. So money doesn't buy happiness, but it does buy some freedom and options. And I think those are two things that you need to keep in mind as we go through these others.
Like anything else, like with great power comes great responsibility. With money comes responsibility, and you have to be able to understand how to handle that responsibility and the money. And getting a lot of money real quick, or like your roommate, or like the lottery winners, or a lot of athletes that sign big ticket things, they don't know how to handle the money yet. They haven't matured into the money yet, and the money then controls them rather than the other way around. It's just a matter of it takes some serious understanding of yourself and of how the world works to be able to not let money screw your life up.
What would you have done? What if you had $100,000 at age 21 or 22? How long would that have lasted? Just thinking back for you.
Well, I've mentioned this many times. If I had inherited whatever you call it, $100,000 when I was 18 or 19, either the money or me would not have lived through the year. One of the two would be dead.
Yeah. Well, I mean, I'm not making light of it, but that's true. That's true. So it does take a certain level of maturity, but that's something you got to think about money. Now, these next three, these other three truths, I think we can spend time on, because these really pertain to the things that we talk about on this podcast. And this one, maybe I'd put this at number one, but it's less obvious. Keeping wealth is different from building wealth. That is one of the truths. We've said this before, there are many ways to get rich, but keeping that wealth requires a different skill set. We're talking about not just living within your means, but protecting what you have and not letting it be taken away by bad decisions or unnecessary risk. Rick, this is what the bucket strategy is obviously built all the way around.
Well, it is. I mean, and the whole idea is that once you've built the wealth, you don't want to lose it. You want it to last. And over history, there's lots of stories. Some of the richest people in the world were broke several times, not just once. They didn't just come from poverty. They made money, lost it, and then they figured out a way. There's lots of books written on how to create wealth, but very few written on how to maintain and not lose it. And so the bucket strategy for somebody, especially somebody who's not a financial, genius, risk taker, willing to throw the dice out there, the buckets are all about maintaining your wealth.
You cannot dollar cost average your way out of the market because you're just asking for trouble. And that was one of the big things that I learned too, Rick, when I was learning about the bucket strategies, this whole idea of reverse dollar cost averaging. If you do what you did saving during the time that you're pulling money out of the market, you're going to be in big trouble eventually.
Well, the two biggest things for the average person to use to create wealth is time and the volatility of the market through things like dollar cost averaging. The two biggest detriments to your portfolio once you have money and you want to take and turn it around and start creating a distribution, cash flow, the biggest detriments are time and market volatility. So what was your two largest advantages become your two biggest problems when you change the direction of that flow of money. Money going in, time and dollar cost averaging works. Money coming out, time and reverse dollar cost averaging do not help.
There used to be a series of TV commercials for a big investment firm, This
I
had
know
to
where
be
you're
20
going.
years. Yeah, it had to be 20 years ago. And they would show this number. What is your number? What's your retirement number? And they would talk about how you build up to that number. Some people it was $1.5 million. Others it was 600,000. Whatever it is. The numbers didn't matter, but they said once you've reached that number, we'll help you reach that number. Get to that goal so you have the freedom, to quit working and all this stuff. And I'm thinking, okay, great. You hit that number. What happens after that? Because what happens after that is even more important than how you got there. And why do you suppose so many people pay so little attention to the most important part of their financial life, the distribution phase?
Because they don't want to pay attention to the first part either. They just want it to happen. And it actually happens to their benefit. Most people don't have a large lump sum, so they're doing dollar cost averaging by default, and it helps. They don't pay attention because they have time, and so they ignore their 401k, and it works. And so they've never had to pay attention to building the net worth. Why should they have to pay attention to distributing it? And because there's so much more written and studied about creating wealth and so little done about distributing it. And to be honest, it's so much more exciting and fun and to talk about, look at how much money we made you or that you could make, rather than, hey, let's be a little bit less greedy here, and we're changing the narrative now. And so now it's not about return. It's about stability. It's about ongoing. It's about boredom. And people don't want to hear about that.
But stability isn't sexy. I mean, you can't point to stability.
It's not sexy. That's why people don't want to talk about it.
You can't. That's right. You cannot point to stability and say, "Look what I've done." In the case of that, I mean, it can go almost unnoticed, but disasters just fail to occur when you do it correctly. And there's very little that you can point to other than you can say, look, everybody's stocks are down, and even yours are down a little, but that doesn't matter. It's not affecting your lifestyle. So I find that's one of the most important things that people need to understand is that keeping wealth is different from building wealth, requires two different skill sets, and you better have somebody who knows what they're doing on the distribution side. So big light bulb moment for me. I remember years ago when I said, that's why the bucket strategy. Now, the fourth thing, truth, which kind of goes along with this. And again, I will say the bucket strategy is kind of designed around that. You folks listening don't need me to tell you that because I think you know this. The fourth thing is that you need room for error. And what do I mean by that? Well, a financial plan that only works if everything goes right, we have said before, is not a plan. Life changes. Markets are often less than optimal. Unexpected events always show up. I saw a great quote. Where was it? Oh, here it is. Room for error, often called margin of safety, is one of the most underappreciated forces in business. Anything that lets you live happily with a range of outcomes. Now, this goes back to, everything that we've talked about so far today, Rick. I mean, if something happens that was unexpected, which happens all the time, if you're okay moving things a little bit, you should be just fine. And that's what having a good strategy will do. Gives you room for error.
Right, and that ability for change, that ability for risk, it affects everybody differently. When I first started in the career, I was working with somebody who had significant support from his parents. He could take a different type of contract, work in a different type of environment where he may not get paid for 4 or 5 months, but he'll make 3 times what I made in a year in that particular type of arrangement. And I couldn't do that. I was just as good or smart as him, but I couldn't go 6 months without a paycheck. So my contract was different. And I had to have that stability. He had backing where he could fail and his parents would bail him out. I mean, it happens. And he was able to go through that until he made a success. And he's made a lot of money. I mean, it's not just the market either. We're moving forward into the future, and we cannot predict what's going to happen, especially over short periods of time, short period being years even for that matter. But so that's one area of uncertainty. But you can't tell me exactly what you're going to be doing a year from now? How are you going to be doing it? How is life going to affect you? How's your retirement going to affect you? How's your family going to affect you over the next couple of years? Is there going to be any changes to that part of your life? Forget the math part. Forget the markets part. Are you going to be exactly the same and continuing doing what you think you're doing right now a year or three now? People that are just going into retirement, the answer is, I have no idea. Now, people that are 85, 90 years old, they've got a pretty good idea. They're pretty systematic by that point.
Mm-hmm.
But younger retirees, they need a plan that not only can handle the uncertainty of the markets and things of that nature, but they can handle the uncertainty of them.
Well, when you look at the bucket strategy, I think, as I said, many of our listeners know what we're talking about. But how does the bucket strategy build in this whole idea of room for error?
Well, we try to take away the error or the need to be predictive on the future markets by having the ability to withstand a market downturn without adversely affecting the overall plan. And we build in enough flexibility, at least as much as we can afford to handle the changes in the individual and their goals and things of that nature. So it has to be flexible, it has to be adaptive, it has to change, and it has to be able to not require everything be rosy in the next 5 to 10 years. Because, hey, things can go wrong. And Murphy's Law says they'll go wrong for you.
Things can go wrong and things will go wrong. So it's just an important part of that. Yes, your bucket 3 might be down, but if that doesn't matter to you, because you don't have to do anything, you can just continue to receive your cash flow as expected, then most likely you're probably not going to care. So the 4 of the 5 things that we've talked about so far, the financial truths. Yeah, the first one was you need to save money, of course. Second one, money does not buy happiness, but it can give you freedom. It can give you options. The third one, very important, is keeping wealth is different from building wealth, obvious to us. The fourth one here we just talked about is that you need room for error because things go wrong all the time. It's kind of like having, room for error on you don't drive, when you're driving 80 miles an hour, cars are not bumper to bumper, are they? You just naturally give yourself a certain amount of room, and the faster you're going, the more room you give the car in front of you. So that's the kind of room for error that we're talking about.
And the other week, I had to fly somewhere, and we were having TSA issues, and so I got to the airport early, just so I could make sure I got through TSA, so that I didn't miss my flight. As it turns out, there was no TSA issue, and I got through in 10 minutes, and I had to sit there for quite a while. But I would rather do that than have come a little bit later on and experience the difficulty that everybody was talking about and then not have made my flight. So I had to build in that room for error, even though ultimately I didn't need it.
Well, it applies to so many things other than finance. That's another perfect example. The fifth thing, the last financial truth that I think is probably irrefutable is that nothing is free. The price of investing is volatility. Rick, market downturns, that's just part of the cost of earning long-term returns. And I think if you understand that in advance and you plan for it, you're less likely to make these damaging decisions when markets fall. I saw another great quote on this. It said, there are no cheat codes in investing. If something offers high returns with low risk, it's probably hiding risk. I know you're
hiding something, that's for sure. I mean, the idea is there is a cost to safety. CDs pay 4% or whatever they're paying. Mm-hmm. But there's a cost to that. The cost is the potential upside that you could have gotten over the time period that you wanted to invest if you had gone away from safety. On the other hand, there's a cost to investing. And that cost of investing is, it could get a more than double return than what a CD is doing, but it could also lose money. So what time horizon are we dealing with? How much can you afford to risk? When do you actually need this money? What's going on? What's the purpose for the money? Everything has a cost. CDs are not risk-free, so to speak. Yes, they're risk-free on the principal, but you may be losing out to inflation. You may be losing out onto other areas that you could have made more money if the time horizons are appropriate. On the other hand, CDs may be the greatest thing going, or things like CDs, for a short period time horizon where you can't afford to lose any money. And you're willing to give up the potential return that would be in excess of what a CD does to make sure you don't lose any money.
We talk about time horizon, and I mean, you need a certain amount of time, you need a certain amount of patience, and you just need to sort of ride out the bad times. Why is it? Is it human nature where people just want to find a shortcut? They say, yeah, I see it. I see my goal down the line, but man, I bet if I took this road, yeah, it looks like a bumpy road. But you know what? This may get me there quicker. What's up with that?
Well, look at all the diets. Does anybody want to do what really it takes? Eat less, exercise more, and eat better foods rather than chips and other things like that. The secret to weight loss isn't unknown. It's just undesirable. So when it comes to these other areas, it's the same thing. We all want shortcuts. We want the magic pill. We want to have it. I want to have a high return. I want to have guarantee of principal. Oh, and by the way, I want it to be tax-free too. Might as well throw that one in there too if we're looking for the unicorn. You can't have everything in one package. It just doesn't exist. Especially when it comes to investing, you can't have it all. So when you have something that's showing very high, what they say are stable or guaranteed returns, with what they say are principal protections, or whatever the case, you have to ask yourself, how are they doing this when nobody else can? What is going on behind the scenes? Something else is happening. What else am I giving up? Am I giving up liquidity? Am I giving up control? Am I giving up? What is it that is allowing them to at least say that these things have that? Now, reality is anything that's paying higher than expected has some kind of risk to it. And the risk is time or money or principal.
I loved your example of the diet, because that's another one that's probably as equally prevalent. The idea that nature hates a cheat code, I think, relates. We just haven't seen what the cost is of that. And when you try to violate the cost, it's like, well, there's a car I want that car. Well, I can either buy it or I can steal it. If I get away with stealing,
it's not an option at this point. And stealing comes with certain hazardous side effects.
I would say. So yes, and it's the same kind of thing. Just understand that whatever you do, there's going to be a cost to that action. So just again to kind of wrap each of these up, and these are not truths that people aren't aware of. We're not giving you folks listening anything that you probably didn't know. But I really think that it helps when we have somebody like Rick Plum here to reinforce these ideas, because to hear them rather than just kind of have them in the back of your mind, I think to hear them and understand why these truths exist can be a real help. None of these are complicated, but as we've said, simple doesn't mean easy. And these are the kinds of things, as I said, if you ignore them, it doesn't matter how good your investments are, what strategy you're using, something's going to break eventually. So, one of the biggest reasons we do the bucket strategy is because of these truths. It's designed around them. It acknowledges that keeping wealth is different from building it. That's one of the biggest things. Because actually, when everything is said and done, I think what really matters is whether your plan actually works for you. Rick, it's about how people live, how they spend, and what they want their money to do for them. I'm sure you'd agree with that.
Oh, very much so. And although we talk about a bucket strategy as if it's one type of plan, everybody's bucket strategy is tailored to them. So every bucket strategy is slightly different because we're dealing with somebody that's different from everybody else. And so they have slightly different nuances. But we still have to have an overall structure that we can then tailor to what we're trying to do for that individual.
Exactly. So if you'd like to talk through your own situation, you can give the advisors at Lucia Capital Group a call, 800-644-1150, 800-644-1150. Rick and the team, they spend a lot of time helping people kind of connect the dots and turning all these moving pieces into something that actually I think makes sense in real life. You can also visit online, website, of course, luciacap.com, LUCIACAP.com. While you're there, make sure you check out the guides that we have available. Try to mention this as often as I can because we get a lot of people downloading. These are very popular. Bucket Strategy Guide, Social Security, Retirement Income, Estate Planning, and a couple of others. It's all there to help you better understand how these pieces fit together. Just type what you're looking for into the search bar in the upper right corner, and you'll see it listed first. As I said, they're all free to download. Don't forget, subscribe to the podcast, Apple Podcasts or Spotify. Don't miss an episode. Plenty more topics coming up. We are out of time. For Professor Rick Plum, certified financial planner professional and accredited wealth management advisor, I am your podcast host, Johnny Dean. Thanks for listening. We'll talk to you all again next week. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice, and its accuracy cannot be guaranteed. There is no guarantee that any investment strategy will meet its stated objective. All investments involve risk, including potential loss of principal. An asset allocation strategy does not ensure a profit or protect against loss. Stock investing includes risks, including fluctuating prices and loss of principal. 401k benefits may be subject to change at your employer, the governing pension, or benefit organization's discretion. A dollar cost averaging strategy does not guarantee a profit or protection from loss. Since such an investment plan involves continual investment in securities regardless of fluctuating price levels, you must consider your willingness to continue purchasing during periods of high or low price levels. CDs are FDIC insured up to $250,000 per depositor per insured bank for each account ownership category. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Rick Plum is a registered representative with, and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC.